What's up, fam? It is day 11. We're going to touch on fair value gaps today, and we're going to go over what they are, what they represent, how they form, what makes it an imbalance. So, to start, imagine this is a bullish example, okay? I'll mark these green, okay? Imagine this is a bullish example. So, price is moving up. Okay, and then it leaves this gap between these bodies from this candle and this candle. There could be a wick there too. Like, for example, it could look more like that. But then there's a volume inversion. That's something else we don't want to get into yet. So it would look something more like this, like that. Okay, and then imagine it vice versa for a bearish example. Okay, price is moving down. So it creates that gap in between the bodies. And we'll show some chart examples as well. I'm holding my little mic. So now that you have a little idea, let's go ahead, hop on the 5 minute. And then now you could start to see it. See the gap between the bodies? Boom. Fair value gap right there. Right? See it? These are imbalances in price. This is where there was made. So in this example that we're looking at on this 5 minute NQ Christmas contract, October 2nd, you could see the gaps that's signaturing to us to sell side imbalance, buy side inefficiency. With that said, there is a major sell imbalance, so there's downward momentum and there's a lack of upward momentum in that moment. It's an inefficiency left behind where the orders of buying and selling were not at pressure. So like you could see 10:05, you see how the body is minimal and the wicks, see how it's more balanced. This is imbalance. This is where selling is pressurized, I would say. Suppose it's not like that. This is where we're on a liquidity run, but you can think about it like that. It's an imbalance in price with long or short, and it's short, short, short. And it's a three candlestick pattern, if that makes sense. Price often retrades too, as you could see. We made this low. If you go to a higher time frame, probably see something relative to where, why, what reasoning for a higher time frame. But I want you to understand swings because we've talked about this. So there's your sell side, right? There's your body closure. And then now we're getting this bullish momentum, to say the least, to run on liquidity. Because if you go on the 1 minute basis, look at these relative highs. It's so smooth. That's a little too smooth. They want to run it. See? And you can see here, fair value gap. With an inversion here. Into that buy side pool. Equal highs relative, which is also that 5 minute fair value gap. See how it lines up? That's if they want to run it there or not. Think about fair value gaps in a way that helps you deliver to what most recent swing liquidity pool you were looking for. So here you could see inversion with that fair value gap. It's almost like cherry picked right there. Look at that. And then look at the time. 11:50, 12:10 that we spool away. Boom. See how you could use it as a confirmation after taking the sell side liquidity. See from 5 minute, sell side liquidity, taken. Test one more, retrade to the sell side. It's normally what occurs. So like you'll come to it once, twice before you disappear. Sometimes it's once, sometimes it's just a wick. You have to be able to read price action and understand price delivery and where it wants to go and why the imbalances are being filled. It's almost like a spilled drink. Before moving on, you wipe the spill. The market wipes the imbalance. See how we've tapped this 5 minute now? These were a little smooth. Left you an imbalance. See how it's starting to formulate? Fair value gaps, swing high, relative, equal buy side created. Macro, which we'll get into more. Don't worry, don't worry. But with that said, I want you to mark out strictly just fair value gaps where it looks like this in this basis. So I'll give you a couple examples now. Fair value gap where it's like this, where it looks like this. You could do the same for the downside if you want. Just mark a couple out and understand bodies and wicks doing damage. I want you to journal it. Were you ever ignoring these before? Now how could you integrate them into your trading? I definitely want y'all to drop like one picture, one screenshot of you going around marking out fair value gaps. Okay? There's one. You know, can't really make it up. They're always there. Looking for market open. Market open. Accumulation. Major accumulation. Look at that. Dealer's range. Look at how Tuesday traded above and below it so many times. First present fair value gap, which is the first fair value gap that presents itself before 10 o'clock and after 9:31. Go to another day. Get another example of the first. So you could see here. Excuse me. Shit, I died. Bearish, we trade above and then back to it. Bodies respecting. That's inversion. First present fair value gap. And then you could see market runs on buy side. I'm gonna sneeze again, but I think you're getting the idea. Let's go to a 1 hour basis. Remove all this. So you could see now they're everywhere. But yeah, with that said, I want y'all to drop at least one or two screenshots marking out the fair value gaps in your chart and seeing what the outcome is in your notes, your journal. And I want you to ask yourself, have you ever been ignoring these before? With that said, we'll catch y'all soon. Later.